Revenue is vanity, profit is sanity, but cash is king. A pleasant day to all. What I just delivered is a quote by Alan Mills, which basically means without a purposeful focus on measuring and growing cash, as well as profit, high growth companies risk running short of it. With that, we'll be presenting today Century Pacific Food Incorporated's consolidated statement of cash flows for this video presentation. Starting with the cash flows from operating activities. As what you can see on the screen, the cash flow from operating activities of Century Pacific decreased by 15.9%, mainly because of the significant increase in inventories due from related parties and prepayments and other recurrent assets, which reduce the cash available from the normal business operations. These increases may indicate that the company is facing lower demand, slower collection, or higher expenses. The company also paid more income tax and had less gain from sale of scrap and disposal of property, plant, and equipment. On the other hand, the company had a higher income before tax, depreciation and amortization, finance costs, and net movement in accrued retirement benefit, interest income, and unrealized foreign exchange loss. These adjustments reflect the non-cash items, the changes in working capital that affect the cash flow from operating activities.
Century Pacific Food Incorporated is a profitable company. The company's income statement ratios show that the company's profitability per peso of revenue decreased slightly from 2021 to 2022. However, its profitability per peso of asset and equity increased. This suggests that the company was able to improve its asset and equity efficiency, but faced some challenges in maintaining its gross and operating margins.
The cash flow from financing activities increased by 141.8%, mainly because of a decrease in payments of short-term borrowings, long-term borrowings, and debt issuance costs, and the increase in the net cash from financing activities. These changes suggest that the company reduced its debt obligations and relied more on its internal funds to finance its activities. The company also had lower proceeds from availment of short-term borrowings and long-term borrowings, which was indicate that it had less need or access to external financing. The cash flow from financing activities reflects the cash raised or paid to finance the company, such as issuing or repaying debt, paying dividends, or raising equity. The net increase or decrease in cash and cash equivalents is decreased by 15.6%, which means that the company had less cash at the end of the period than at the beginning. This may affect the company's liquidity and solvency as it may have less cash to meet its short-term and long-term obligations. The cash and cash equivalents represent the most liquid assets of the company, such as cash, bank deposits, or marketable securities.
Moving on to the company's cash flow ratio analysis, the company's current liability coverage ratio decreased from 0.21 in 2021 to 0.18 in 2022. This can be gleaned that the company may or will face challenge and risk in meeting its short-term obligations with its current assets. This is due to the increase in current liabilities. Next, under the operating cash flow ratio, the company's operating cash flow ratio decreased from 0.23 in 2021 to 0.16 in 2022, which means the company faced challenges in generating cash from its operations to meet its current liabilities. The lower ratio indicates decline operational efficiency and cash management. This is due to the decrease in operating income and increase in working capital.
On the other hand, the price to cash flow ratio increased slightly from 36.1 in 2021 to 37.4 in 2022, which indicates that the company's valuation increased slightly in the last year. The price to cash flow ratio measures the market value of the company relative to its operating cash flows. The ratio is high for both years, which means that the company is valued by the market. So looking at the asset efficiency ratio, there is a decrease from 0.07 in 2021 to 0.05 in 2022. So which indicates that the company's asset utilization is low for both years. Moreover, this can be gleaned that the company is not able to utilize well of its asset to generate revenue. Lastly, the external financing index ratio increased significantly from 0.17 in 2021 to 0.50 in 2022, which suggests that the company increased its external financing dependence the last year. This ratio measures the proportion of funds that the company obtains from external sources, such as debt or equity, rather than from its operations. This ratio is positive for both years, which means that the company relies on external financing to fund its growth.
The results of the cash flow ratio conclude that the company's financial position and performance in generating cash to meet its obligation is both low from 2021 to 2022. The company needs liquidity, efficiency, and profitability monitoring and increase its financial leverage and risk. The company may need to improve its cash flow management, optimize its asset utilization, and reduce its reliance on external financing to improve its financial health. To improve its liquidity and solvency, the company should increase its operating cash flow by increasing its sales, reducing its cost, or improving its margins. To improve its asset efficiency, the company should optimize its asset utilization by investing in more productive assets, disposing or ideal or obsolete assets, or improving its inventory and receivables management. To reduce its external financing dependence, the company should increase its internal financing by retaining more of its earnings, reducing its dividends payout, or issuing more shares. To reduce its market overvaluation, the company should increase its transparency and disclosure, improve its corporate governance and social responsibility, or adjust its growth expectations.